In most cases, these businesses represent your life's work, the blood, sweat, and tears of decades. Now, the irony here is that we've seen a lot of entrepreneurs who are approaching retirement and they don't really want to work as hard anymore. They're ready to turn it in. They're convinced by many financial professionals that the way to go is to sell their business and then to buy some portfolio of stocks and bonds. And in many cases, if not most, that is not a good decision. One of the reasons for this, or a couple of reasons for this, is number one, financial advisors get paid on the assets, typically the public stocks and bonds that they recommend. The broker dealer gets paid a commission on what he sells you. The investment advisor gets paid on the total value of the stocks and bonds that you hold with them. So they have an economic incentive to rotate you out of your current private business and into their portfolios. Secondly, most retail financial advisors know nothing about private assets. We struggle with this a lot on the private side. We construct relatively complex solutions for the institutional space, family office space. And periodically, we try to make a foray into the retail market. And all of the advisors who work in that space, they find it very difficult, if not impossible, to wrap their heads around how to account for and work with private assets, whether it's a private structured product that we design or your private business. So 60 years ago, as Warren Buffett would discuss, it probably made sense to just buy publicly traded stocks. That's not the case anymore. Everything bubble from the Fed's recovery attempts post 2008 have inflated every asset class, and that really hasn't gone away. In other words, everything is really overvalued. One simple way of looking at that is price to earnings ratios of public stocks. Also, if you just look at their volatility, how much they go up and down, particularly how much they go down, there's a substantial risk of loss at any given time. So 2008, the S&P 500 lost about 50%. So it's a long-winded way of saying there are an enormous number of headwinds with respect to finding a financial advisor who will give you sound advice. On the other hand, there's a reason that most entrepreneurs run their own business as opposed to just investing in the stock market, because it makes them a lot more money. It's a lot better investment. Now, if it's properly accounted for, if you pull out a salary for the role that you play in your business, assuming it's an actual business, in most cases, or at least in many cases, that privately held business is a far more valuable asset than any stock you're ever going to buy. It's not uncommon for entrepreneurs to have exposure to capital markets beyond their business. But if your business is the best thing going, that's where all of your time and money should go. Now, with respect to what to do with your business and how to handle retirement. So now look, a lot of small businesses are not very good. They're not very well run. They really don't have any value. A lot of entrepreneurs are really just consultants that are getting paid in a 1099. They call that a business. Fine, it's great. And in that case, that might be a little bit different. But if you've got a business where it runs a systematized process, and at least in theory, someone could be trained to replace you in your business, the best decision is probably to maintain ownership of that business and to, instead of selling it, finding new management, effectively replacing yourself in that firm. Now, one of the challenges with that we've seen also is some entrepreneurs don't only have to replace their expertise, but they also have to replace their relationships. It's not uncommon that the business owner has relationships that are invaluable to the business and may be difficult to pass on. Again, doesn't make it impossible, especially if you plan in advance and have someone, an apprentice, so to speak, with you through the year or couple of years preceding your retirement. you teach them what you do, and then you warm up those relationships and preparing for a transition. I don't think it's a ridiculous analogy, maybe not today, but a few decades ago when you had the nightly news anchor, the same guy for 30 years, and everybody got really familiar and had a warm fuzzy about the same news anchor every night at 6 o'clock. And then, oh goodness, he's going to retire. We need somebody else, right? They start bringing him in. They start warming up that relationship. And not too long, you get used to the new anchor and you've got the same level of familiarity. Similar idea with from the perspective of the business owner is, while there are a lot of businesses that do have the potential to be held on to with new management and onboarding of new management and transition of those relationships, a lot of business owners don't really see the value in their business. And a big part of that is oftentimes just because it's not managed quite as well as it could be. Oftentimes, we'll find really good privately held businesses that may be missing one or two things, right? So like the owner is an expert in some field, but they don't necessarily know business in general. And somebody like Daniel or any number of business consultants you're going to find can come in with one or two really easy tweaks to take that business from something that doesn't have the capacity to stand on its own 2 feet to something that does. And again, hold on to that indefinitely as opposed to selling out of it and rotating into a portfolio of stocks and bonds. So how might you do that? So the various paths that can be taken, the solutions employed, can vary substantially depending upon the individual circumstances. So I'll start with the simplest situation. The simplest situation is it's one business, it's maybe one entity. The business owner is also the executive manager. And then in that case, it's really a matter of, again, year or two, maybe 3 or 4 or more in advance. Thinking ahead, finding someone, maybe it's your kids, maybe it's not, maybe you've found their headhunter, whatever. Finding someone a protege that you can bring in, teach them, who demonstrates the capacity for leadership, by the way, to teach them how to manage the business, introduce them to the relationships that drive the business, and then over that 2 or 3 year period, gradually hand over the ropes such that you can step away. And at the end of a 1, 2, 3 year period, you're no longer involved in the management, but you still maintain ownership. So you don't sell the business. You just pay this new manager a salary, maybe give them a small equity take to create aligned interest. But again, the majority of your holdings are preserved, not only in what would probably be the best economic and financial decision, but also to preserve your legacy. If you can maintain that and hold it for posterity, not only as a great potentially financial decision, but just you're preserving a bit of yourself beyond your lifetime. So that's the simplest situation, one entity. We've had a client that has, and most do, have multiple entities, maybe vertically integrated businesses or slightly disparate but yet related businesses. In that case, it might make sense to roll everything under a private equity structure. And in those cases, again, most of these business owners don't necessarily know a lot about private equity, but we can help with that. We can help structure and manage the private equity firm while still facilitating that same sort of approach we talked about with the single entity, where we bring in and help bring in new management potential proteges to learn how to run the business and then facilitate those relationships. That same private equity structure at the next level might be utilized to grow and create, again, a much bigger firm or business or company after you've left. So not only can that private equity firm simply hold the businesses that you currently own, but we can also use that to capitalize expansion by buying more and more businesses that are still under your effective ownership.
And there might obviously also be a couple of advantages related to liquidity events, and you sell off one portion of it or one of the sub companies or the whole thing. If you have a private equity type of structure, it might be beneficial compared to you just being the owner of the company and having that liquidity event.
Yeah, so certainly there can be tremendous tax benefits that are structured in. For example, potentially money can be taken out in the form of a loan, which is not taxable, as opposed to having to sell things. You could sell off bits and pieces. You could break things up and sell one piece potentially more than what you would have potentially sold the whole thing for at one point in time. So it just opens up an infinite array of possibilities in terms of what you can do that just fall far beyond the scope of the expertise of any financial advisor for the most part.
If you would basically roll up the company into a level where you all of a sudden even changing buyer's profile and become attractive for bigger private equity, it's almost impossible to create similar return potential with anything else that you could do with the money if you would just sell the business.